Welcome in, everybody. It is Retire with Confidence with Bill Geiger of Geiger Wealth Management. And Bill's been working with couples in their late 50s to early 60s for close to 4 decades now, helping them prepare for retirement. Bill, what's the topic of today's show?
Brett, I thought we'd talk today about how that last 5 to 10 years before you retire, how that should be different, how your portfolio should be different from what it was before. Mm-hmm. And for example, if you're in your 30s, 40s, you can blow your portfolio up, and you've got 30 years to make it back again. Someone who's in their late 50s to early 60s doesn't have the luxury of that, so they need to make some serious changes to their portfolio when they get that age range, basically 5 to 10 years from retirement.
And I would imagine a lot of that has to do with risk.
It does. It does. Whether you've saved $500,000, $10 million, or $40 million, you really have 3 big jobs to do when you're 5 to 10 years from retirement, and they're critical. The first one is you want to protect what you've accumulated so far, what you've worked so many years to accumulate, to grow. You've been through markets ups and market downs. You need to protect that, because the last thing that you want to do at this stage is to go backwards. You don't want to have any losses at this time. And that's critical. If we have a big loss like we did in 2008, that takes 5 years to get back to breaking even. So the last thing you want to do is to go backwards. So your first big job is to protect what you've worked so hard for. The second big job is to continue to make it grow. Now, you're protecting it, but you need to continue to make it grow. I've done this for 40 years. I've never once had anybody tell me they had enough money for retirement. It just right. Doesn't happen. If you've got $1 million, you want 2. If you have 2, you want 5. And it just keeps going like that. I had a guy once sitting down in front of me with $40 million, and he said, Bill, he says, if I could just get to 50, I'll be happy. So it doesn't change. So in addition to protecting what you have, Brett, you want to be able to make it grow too. Grow safely, consistently, but continue to grow.
Well, and I imagine that's kind of a fine line to walk between protecting what you have, but able to consistently grow at the same time.
We have this I think what you're alluding to is this perception of risk and return. Mm-hmm. That in order to get big returns, you have to take big risk. And that's not necessarily true. And in a little bit later on this segment, we're going to talk about how you can grow your money safely and still get market-like returns without an issue. So it's not necessary that you give up return to protect what you have.
And then I know you said there's 3 jobs. What's the last job that you have? These are 5 to 10 years from retirement.
The last job, and maybe this is the most important job, is to make it work for you in retirement, to make your portfolio really work for you.
And what do you mean by that?
What I mean by that is we need to begin creating income for you. As you're approaching retirement, part of the shifting your portfolio, part of the rebalancing your portfolio, is to be able to create income. Brett, when we retire, by definition, there are no more paychecks.
Correct. Yes.
And as I say that, I know there's going to be a lot of people listening that kind of shudder a little bit. Maybe, and particularly maybe, the spouses. A lot of times, couples come into my office, the man is kind of driving the bus with respect to investing, but the woman is driving the bus in terms of paying the bills every month mm-hmm. and keeping everything together. And one of the ladies' biggest fears is, how am I going to pay my bills? How am I going to pay our bills every month when my husband's no longer working? And that's a real fear, and it's a real concern, and it is a important concern because it's a big question. How are you going to pay your bills in retirement? And so the third big job you have is when you're getting closer to retirement to begin transitioning a portion of your portfolio so that you have the income necessary to pay your bills. And you want dependable income. You want sustainable income. You want to be able to count on it. You want income coming in each month, just like your Social Security.
What is that transition like for some people, Bill? Because I imagine it is a big shift in thinking for either a couple or somebody who has had a consistent paycheck, and then they just see their money continue to grow. And then you kind of have to walk them through this idea that, yes, your money's going to continue to grow in retirement, but also you're working with, at times, a finite amount. You won't have that income coming in, like you mentioned, with a paycheck.
Yeah. A lot of times it's a different way of looking at the world than what our clients have had. They've been working for 30 years, 35 years, maybe more, and they put money into a 401k plan. They've watched that grow. They've saved money outside of that. They've watched that grow. And the basic modus operandi, the basic manner in which they've been creating their wealth is saving and investing in the stock market. Saving and investing in the stock market. And being invested in the stock market, they go through the peaks, they go through the troughs, they go through the euphoria, they go through the fear and the upset. And they've been doing that for years. And one of the things that helps temper that feeling, one of the things that helps them get through that period with the ups and downs is they have a paycheck coming in. And if you have a paycheck coming in, it's easier to watch volatility. It's easier to live through it. You want to know when it's not easy to go through volatility? When there's no more paychecks. As a matter of fact, one of the things I'll ask clients is I'll ask them, how often do you look at your portfolio? And for a lot of folks, it's like once a month, or I look at it once a quarter. And I tell them, I guarantee that when you no longer have a paycheck, you'll look at it more frequently than that.
I would guess so, yeah.
Especially if the market's going down. If the market's going down and you're working and you've got a paycheck, the little conversation you have with yourself is, well, it'll get better. I don't need it right now. I have my paycheck. My wife has her paycheck. We're doing fine. I don't need it right now. So you kind of turn a blind eye to your portfolio sometimes a little bit just to kind of get through that time period. But when you are retired and you no longer have those paychecks, it affects you tremendously different because you look at your portfolio and there's a realization. And this comes shortly after you retire. As much as we know there's no more paychecks, intellectually, we don't know it in our gut until 2 or 3 weeks after we've retired, and it actually hits us. My employer is not sending any more checks.
Right.
There's just no more.
It's frightening in a way.
It's frightening, and then you immediately look over at your portfolio, and you realize that unless you win the lottery or you have a big inheritance, this is the money that has to last you for the rest of your life. So you have a much different relationship, if you will, with your portfolio when you get in that time period.
Well, and it's a different lifestyle as well. You're not only not working more, but ideally, I'm sure a lot of retirees that you speak to have this idea of a different lifestyle after they retire that probably is going to cost them differently than what they've been doing for the past 30, 40 years.
And sometimes there's a misconception there. And the misconception is that it won't cost them as much in retirement to live. Absolutely wrong. You may not be taking as many clothes to the dry cleaners. You might not having as many lunches out, but you're going to be traveling. You're going to be spoiling the grandkids. And then there's a misconception, well, it won't cost me as much later on because we'll have the traveling done. Well, the reason that the traveling is done is because of, generally for health reasons, you can't get around as much anymore. And those replace the travel expenses. So you really have to count on the cost of living in retirement to continue to go up the same way that it has been all these years.
You're listening to Retire with Confidence with Bill Geiger of Geiger Wealth Management. Bill, I know in the second half here, we're going to kind of break down into those three jobs and how you folks over at Geiger Wealth Management can help those near retirement fight through those three jobs. If people want to get a hold of you, how can they do so?
Brett, we're going to do something special today. The first 5 callers who call in, and I'm going to give the phone number in a moment, the first 5 callers with a portfolio of at least $500,000, we're going to sit down with them, and I'll sit down with them personally on a complimentary basis. It's normally a $5,000 value. I'm going to sit down with them personally, no cost, nobody watching the clock, and we're going to sit down and put together a full-blown retirement plan. This is for the first 5 callers. The number to call is 800-681-2498. I'll sit down with you personally, and we'll put together a retirement plan so you know exactly what you need to do, how to do these 3 big jobs so you can retire comfortably. Again, 800-681-2498. That's 800-681-2498.
Now, Bill, we mentioned the 3 jobs that your portfolio has in the last 5 to 10 years in investing before you get to retirement. The protect what you have, continue growing it, and make it work in retirement. Could you maybe go through those for us and what you folks over at Geiger Wealth Management do to help people prepare for retirement with those 3 jobs?
Okay. The first 2 jobs, to protect it and to continue to grow it with the protection, what we do is our clients own index funds, S&P 500, for instance. They own an index fund on the market. So when the market goes up, they go up. The S&P 500 index also goes down. The index funds go down when the market goes down. So to protect it, we buy portfolio insurance on that.
Okay.
It's kind of like putting a safety net underneath your portfolio. It's kind of like buying insurance on your car. You would never dream of driving your car without car insurance.
Right.
Well, we would never dream of a client having a portfolio in retirement without portfolio insurance. We want the full upside of the market, the S&P 500. We want it, if the S&P goes up 25% in a year, we want to ride that. But if it goes down, that's where the portfolio insurance kicks in and protects the lion's share of the downside. For instance, in 2008, the S&P 500 dropped 52%. Our portfolios dropped around 10 to 12.
Mm-hmm.
Now, you don't want to lose 10 to 12, but it's a whole lot better than going down 52%.
Right. Yes, it is.
So we combine number 1, protect it, and number 2, continue to grow it in kind of one step. We use index funds and we buy portfolio insurance to go underneath those. And that works out really, really well over time. It allows us to continue the growth, but it also allows us to make sure that if the market really heads south, that we don't participate on the downside.
Well, and I think that goes back to that fine line that we were talking about earlier, because I would imagine you sit down with some people and they come in and they say, well, I'm 5 to 10 years from retirement, so I just make my portfolio as low risk as possible. But that's not the correct way to continue to grow your account, that second job that you've been talking about.
No, with the way that inflation is, the way that it has been, and the way it's going to be through 20, 25, 30 years of retirement for you, you need that growth to stay up with inflation. Critical. So the protected part and the continue to make it grow part is we kind of handle in one part of the portfolio. The other part of the portfolio we use to make your portfolio work for you in retirement. And what I mean by that is we want to create dependable, sustainable income that you can count on. You need checks coming in every month, just like your Social Security, just like your checks were when you were still working. Mm-hmm. Critical. Because if you have, and actually, Brett, we don't just want to pay our bills. We want more income coming in each month than what we need.
Right. And so how exactly do you do that? Because it sounds like it's something that might be easier said than done.
Well, it's not that hard to do, but the reason that we want more income than what we actually need is that excess income builds up in a savings account.
Mm-hmm.
And it continues to build up. You have more coming in each month than what you need. It builds up in a savings account. Then when you want to go on vacation, you need to fix the roof in the house, you need to buy a car, you go to that savings account and spend that money because you know how it's going to be replaced. You know if you take $20,000 out to go on a vacation, it's going to build itself back up because you've got more income coming in than what you need.
And it does tie into that idea of, say, passive income, where as opposed to your paycheck, you have that active income coming in. And I would imagine that helps your clients kind of sift through that fear, especially we mentioned those first few weeks where you realize, holy cow, I'm not getting a paycheck anymore. But seeing that other types of income grow has to assuage a lot of fears.
Yeah, it does. And basically, after a few months of having a new paycheck, if you will, from the income part of our portfolio, after a few months of having that come in and realizing, yeah, it comes every month. Yeah, it's more than what we need. That's when you kind of settled in to your retirement. That's where you start looking around you saying, okay, that part's squared away. Now what am I going to do with my life? What am I going to do today? Where are we going to go? Are we going to travel to see the grandkids? Are we going to take a vacation that we haven't done for a long time? Are we going to Europe? You start being able to think about those things because you're not worried.
And I would imagine that anxiety, that fear that you are either going to run out of money or you see the income going away, that is a big part of it. What you just mentioned there is the grandkids or going to go see family and things like that. And when that income isn't there, or when maybe it's a better, when you see that income growing, that gives you the confidence to go out and say, hey, no, we can do this because we have this income coming in, even if it's not through a paycheck.
Yeah, and you're not spending your principal. You're spending the excess income, which is a whole different story. If you're spending your principal, then you have to start worrying about, am I spending too much of my principal? Is it going to last? And you touched on a fear that's probably in the back of 90% of the people's brains that come in to sit down with us. And that's the fear of somewhere in the future running out of money. And it's a very real fear. And, it happens. You go to a Jewel Osco. That's where I go for my groceries. And you get to the checkout register, and there's that nice 75-year-old lady ringing up your grocery purchases. Brett, she's not there because she enjoys meeting new people.
Right. Yeah.
She's there because she's run out of money or she's darn close to it. I saw a guy that had to be 80 bagging groceries the other day. Same sort of thing. Is people have either run out of money and all they have left is Social Security, or they're darn close to it and they're kind of freaking out. And imagine yourself in that position. Imagine yourself that all you have to live your retirement is Social Security.
Yeah, it's frightening.
I mean, if you and your wife both worked and you both had $6,000 or $7,000 a month coming in for Social Security, and that's on the high side. Most folks spend more than $6,000 or $7,000 a month. If they don't now, they're going to be as inflation continues to kick in. So, and let me give you an example, Brett, about how this all kind of comes together. We had a client come in the other day, a doctor, had $1.5 million portfolio.
Excellent.
And he's 60 years old. He wants to work until he's 70. He enjoys what he does. He really, really likes it a lot. He's got $1.5 million portfolio that he's concerned about giving that back to the market. He's concerned about how does he make that work for him in retirement. Now, he's going to be saving and investing for the next 10 years. But what we did right now with his $1.5 million portfolio, we took $500,000 of that and put it into hedge funds that we have the portfolio insurance on. That's going to continue to grow, going to continue to grow nicely, but he's going to be protected on that part of his portfolio for many big downturns. We took $1 million of his $1.5 million and we put it into a tool called a retirement income annuity. And just like the name of this annuity, it's what it's designed to do. It's designed to create retirement income. You cannot lose money in these annuities. They continue to grow over time, but most importantly, they provide a guaranteed income that folks can count on. For this doctor's situation, we put $1 million in that at 60. At 70 years old, he is guaranteed $144,000 a year for he and his wife for the rest of their life.
And that's incredible.
Just out of the $1 million. He still has the other part that's growing. He still has money that he's going to be saving and growing for the next year, 10 years. But on that $1 million, he's guaranteed $144,000 a year for the rest of his life. Now, you take $144,000 and you add in their Social Security of another, 7 times 12? 84,000?
Yeah.
84,000. You've got over 200 that he'll have over $200,000 a year coming in for the rest of his life. He doesn't have to miss a beat. That's over $16,000 a month. And his portfolio is going to continue to grow. He's going to have a way to stay up with inflation, but he knows right now how he's going to pay his bills for the rest of his life once he retires. Extremely, extremely powerful.
Well, I think, one, that's an amazing story, but two, it also shows how being proactive about your retirement can be beneficial to you, because you are giving him an opportunity now when he's 10 years away from retirement to know ahead of time where he's going to be and prepare for his life that far down the road. You know, if somebody comes to you and they say, hey, I'm retired, or if they're trying to plan right before they get up to that final edge, you were talking people who, might only check their portfolio quarterly. It's a different opportunity as those who take the time, be proactive, and get out ahead of this thing and truly try and prepare for retirement.
Yeah, the 5 to 10 years out, the sooner you can come in, the more powerful what we can do for you is.
Bill, if people want to get a hold of you and have a meeting and say go through if they are that 5 to 10 years away from retirement, how can they reach out to you?
Brett, what we're going to do is we're going to take some calls. The first 5 callers who call in today who have a portfolio of at least $500,000, I'm going to sit down with them personally, work up a plan just for them, for their particular situation, what they're trying to accomplish. We'll put this plan together on a complimentary basis, absolutely free, no cost. It's normally a $5,000 value. We're going to do it complimentary to the first 5 callers who have at least $500,000 saved up for retirement. The number to call is 800-681-2498. That's 800-681-2498. And Brett, if they call in, I think they're really, really, really going to enjoy this, because I'll tell you what I hear a lot. I hear a lot from folks, no matter how much money they have, is I don't quite know if I'm doing what I should be doing at this time. I'm not sure whether I'm heading in the right direction, whether I'm doing the right things, whether I have the right portfolio, whether I'm set up correctly for retirement. And this retirement planning session, which again we're going to do on a complimentary basis, is designed to do that, to have a plan in place so you know you're doing the right thing, you know you've set yourself up for success in retirement, and you can relax and breathe. Again, folks, 800-681-2498. That's 800-681-2498.
Be one of those first 5 callers, again, with $500,000 or more in your portfolio, 800-681-2498. Take some of the guesswork out. Let Bill sit down with you, have the conversation and get you set for retirement. Talk about those 3 jobs with Bill: protecting what you have, continue growing it, and making it work for you in retirement. More Retire with Confidence with Bill Geiger of Geiger Wealth Management coming up. That'll do it for this edition of Retire with Confidence with Bill Geiger of Geiger Wealth Management. Bill, it was a fun one.
Thank you, Brett. I enjoyed our recording also. And folks, if you're listening out there, thank you very much for listening, and God bless.